Hi, this is Loretta of Loretta Makes a Million. I'm the one taking a challenge to make $1 million in profit from trading options over the next number of years. Today you are watching video number 3, Option Basics, Long Puts. You should have already watched video number 1, Option Basics, Long Calls, and video number 2, Option Basics, Short Calls. Before we get started, I want everyone to understand that this video is for educational purposes only. I am not a registered investment advisor. I am not offering investment advice. Please be aware that there is risk and potential losses associated with options trading. If you're watching this video on YouTube, then come to my website, lorettamakes-a-million.com. There you can sign up for my free newsletter to stay up to date on my trades, helpful hints exclusively on my site, and other exciting information. In this video, we will review what is an option contract. Then we will discuss what is a put option, what does it mean to be long a put option, and we'll take a look at a profit and loss chart for a long put. Let's begin. What is an option contract? An option contract is an agreement between a buyer and a seller that gives the buyer of the option the right, not the obligation, to buy or sell an underlying at an agreed upon price by a set date. What is a put option? A put option gives the buyer the right, not the obligation, to sell an underlying at an agreed upon price by a set date. Buyers of puts want the price of the underlying to move down. The buyer of a put option is said to be long the put. Call options give you the right to buy an underlying. Put options give you the right to sell an underlying. Buyers of puts and calls are long the option. Sellers of puts and calls are short the option. I am going to use an example of insuring a house to help demonstrate a long put and why you might buy one. Let us say you decide to sell your house. You list it for its market value of $100,000. You are worried that the market value of the house will drop in the next couple of months. You pay an insurance company $5,000 for the right to sell the house for $100,000 within the next 90 days. By buying insurance, you are protecting the value of your home. The premium is a $5,000 debit. The strike price is $100,000. The days until expiration are 90. The underlying is the house. Question: what if the value of the house drops to $50,000 in the next 90 days? You have the right to sell the house to the insurance company for $100,000. In other words, you have the right to put the house to the insurance company. The insurance company is obligated to buy the house from you for $100,000. Notice that I said that the insurance company is obligated to buy the house from you. Sellers of options are obligated to fulfill the contract if it is exercised. In this example, the insurance company is the seller of the option. Question: what if the value of the house drops to $50,000 in the next 90 days, but you no longer want to sell the house? Let's assume that you can sell back your insurance to the insurance company. The house has dropped in value by $50,000. Your $5,000 insurance contract is now worth more money. You sell the contract for $25,000. You make a profit of $20,000. And you get to keep your home. Here's how the profit is derived. You subtract $5,000, the debit you paid for the insurance contract, from the $25,000, the credit received for selling the insurance contract, for a profit of $20,000. The insurance company would rather pay you $25,000 to buy back the insurance than lose $45,000 by buying your house for $100,000. Here is how the loss is derived. You subtract $50,000, the current market value of the house, from the $100,000 strike, for a loss of $50,000. But remember, you paid a $5,000 premium for the right to sell the home. This $5,000 premium will reduce the insurance company's loss to $45,000. Question: what if someone offers to buy the house for $150,000 in the next 90 days? You can sell the house to the buyer for $150,000. The option will expire worthless, and the insurance company keeps the $5,000 premium. Let us move on to some market examples. On September 24, 2014, Google is trading at $588. You think the price of Google will decrease over the next couple of months. You buy one contract of the November 2014 $590 put option for a $21 debit that will expire in 58 days. The premium is a $21 debit. The strike price is $590. The $590 strike is the at-the-money strike. The at-the-money strike is the strike that is closest to the current market price of the underlying. The underlying is Google stock. Remember that one option contract is equal to 100 units of the underlying. In this example, one contract is equal to 100 shares of Google. The days to expiration are 58. The expiration month is November 2014. Question: what if the Google stock price decreases to $533 at 39 days to expiration? You check the market to see how much you can sell this put for. The market is at a $61 credit. You sell the long put option for a $61 credit. You make a profit of $4,000. Here is how the profit is derived. You subtract $21, the debit paid to buy the put, from $61, the credit received to sell the put, which would equal $40. $40 times 100 shares of Google would equal $4,000. In this example, we made money by buying and then selling a put. We made money without selling any stock. Another reason investors buy puts are to protect their investments. For example, you are worried that your 100 shares of Google will go down in value over the next couple of months. On September 24, 2014, you buy one contract of the Google November 2014 $590 put option for a $21 debit that will expire in 58 days. On November 21, 2014, the day the option will expire, Google is trading at $537. You have the right to sell 100 of your Google shares for $590 per share. If you sell the 100 Google shares, you will net $56,900. You subtract the $21 debit paid to buy the put from the $590 strike price, which would equal $569. $569 times 100 shares of Google would equal $56,900. If you had not bought the $590 put and you had to sell your 100 shares of Google on November 21st for $537 per share, you would have sold your shares for a net of $53,700. You made $3,200 more by buying the put. By buying the put, you protected your investment. You have the right, not the obligation, to sell your shares at any time before expiration. But what happens if the put is even 1 penny in the money at expiration? In this example, the put is 1 penny in the money when Google has a stock price of $589.99. A put is in the money when the put strike is greater than the current market price of the underlying. $590 is greater than $589.99. In the money for a put means that the buyer of the put is able to make money by selling the stock above the current market price. It does not take into account how much of a debit you paid for the put option. In this example, The current market price is $589.99. If you sold 100 shares of Google for $590 per share, you would make a $1 profit. That means that this put is in the money. At my brokerage, if your long put option is even 1 penny in the money at expiration, the option will be exercised. If you have 100 shares of Google in your account, those 100 shares will be sold. If you do not have 100 shares of Google in your account, then your account will be short the 100 shares. You will have to buy 100 shares to cover the short. If you do not want the in-the-money put exercised, then you need to sell the put before expiration. Question: what if the Google stock price increases to $640 at expiration? You will not exercise the option. It will expire worthless, and you will have a max loss of $2,100. Here is how the loss is derived. $21, the debit you paid to buy the put, times 100 shares of Google, which would equal $2,100. The maximum loss for a long put is the debit times 100 units of the underlying. You have the right to sell 100 shares of Google for $590 per share. You will not sell 100 shares of Google for $590 per share if the current market value is $640 per share. In this example, we let the option go to expiration. Remember, we can sell the position anytime before expiration. Question: what if the Google stock price increases to $620 at 39 days to expiration? You check the market and you can sell the put for a $6 credit. You lose $1,500. Here is how the loss is derived. You subtract the $6 credit received to sell the put from the $21 debit paid to buy the put. $15 times 100 shares of Google would equal $1,500. You have a loss, but not a max loss, of $2,100. Now let's take a look at a profit and loss chart for a long put. On December 12, 2014, Google is trading at $521.81. You buy one contract of the February 2014 520 Google put option for a $22.50 debit that will expire in 69 days. The red line is the profit and loss graph of a long put at expiration. For now, we are going to focus on the red line and ignore the white line. Here is the zero line. Any point above the zero line is profit, and any point below the zero line is loss. The dashed red line represents the price that the stock is currently trading at. In this case, it is $521.81. Here is the strike price. Here is the break-even point. The break-even for a long put is the point the stock price needs to be less than in order for us to make money at expiration. The break-even point for a long put is determined by subtracting the debit paid from the strike price. In this case, a debit of $22.50 is subtracted from the 520 strike for a break-even of $497.50. We need the price of Google to be less than $497.50 to make money at expiration. We want the market to go down. You can make a large profit on long puts, but the profit is limited. The stock price can drop no lower than $0. Long puts have limited loss. The maximum loss for a long put is the price of the debit times 100 units of the underlying. In this case, $22.50 times 100 shares of Google would give you a max loss of $2,250. A Google stock price of $520 or higher will result in a max loss. What if Google ends up between the strike and break-even point? The buyer of the long put will have a loss, but not a max loss. For example, if Google ends up at $510 at expiration, you will have a loss of $1,250. Here is how the loss is derived. You subtract $597.50, which is the break-even point, from $510, which is the price of Google at expiration, which would equal $12.50. $12.50 times 100 shares of Google would equal a loss of $1,250. This graph represents the general profit and loss graph of long puts. Long puts have limited profit and limited loss. Now, let us talk about the white line. The white line is the profit and loss graph of the long Google put today. As each day goes by and we get closer to the expiration date, the white line gets closer to the red line. You will note that for a long put, you can make a profit sooner on the white line than the red line. For example, if Google had moved down today to $510, you could sell this position and make money. At expiration, you would lose money if Google was at $510. Remember, you can sell a position any time before expiration. Let us review what we have learned in this video. A put option gives the buyer of the put the right to sell an underlying at an agreed upon price by a set date. The buyer of a put option is said to be long the put. Long put options benefit when the market moves down. When the price of the underlying goes down, the buyer of the put option can sell the option at a higher price and make a profit. Long puts have limited profit and limited risk. That's it for this video. Please join me for my next video, video number 4, Option Basics, Short Puts. Thanks for joining me on my $1 million journey.